pleasure to have with us Brian Barris of Barris Capital Management. Brian, welcome.
Thank you.
Brian, I'd love to hear a bit about your background before we delve into the world of small caps, which is your focus. So if we could start with your background and how you got interested with investing.
Sure. So I started reading the Buffett annual letter when I was in high school. I'm from Omaha originally, and so my interest was piqued by basically the geographic proximity of the world's most famous investor. Would wait with bated breath each year as the annual report came out, would tear it apart, started reading annual letters of other companies, went to the University of Nebraska and focused on mathematics and actuarial science. But my passion was always in my free time reading and understanding businesses, and so knew that I really wanted to be an investor long term in the sort of Buffett and Munger mold. Always felt like I could eke out an advantage in smaller companies because they're underfollowed, less professional analysis in the space, and thought it would be a great idea to structure a business around that concept. The problem was that I didn't really have a good sort of operational background for professionally managing money. So I found my way to Austin, Texas, and worked for a fellow who was a Wharton MBA and CFA who was structuring a portfolio around quantitative backtesting for Buffett-like characteristics. But he had up and running a registered investment advisor with a mutual fund and was professionally managing institutional money at the time. And he was very generous with allowing me to get up to speed operationally in understanding how to professionally manage money. I would have stayed with him my entire career because I enjoyed working for him. He was very generous both in time and responsibility. But small cap hit a real bear market in the late 90s. The fund and firm started to hemorrhage money, and so I decided to take a crack at it myself and start Bears Capital in June of 2000. We took a little bit of a departure from the philosophy and process that my old firm was using, in that we weren't backward looking and quantitative in nature. Moreover, we didn't hold 50 to 100 stocks. I thought that the surest path to outperformance was being highly convicted about your ideas and manifesting that in terms of the number of positions in the portfolio. So our current process is highly analytical, in-depth research, and the conviction is reflected in a 10-stock portfolio in the small and microcap space. And I also learned that backtesting and quantitative metrics, while fun to research and fun to talk about in books and in the Financial Analyst Journal, it didn't make a lot of sense to me to look at backward-looking accounting statistics and try and draw conclusions about what would happen in the future. Our process and philosophy is very much about analyzing the qualitative aspects of businesses, in particular the factors germane to future outperformance in terms of internal business compounding. So very much a Buffett and Munger philosophy, but the search, despite my quantitative background, despite my mathematics, my studies in mathematics, is becoming more and more distant from the actual, computational parts of investment management, and is gravitating more and more towards the analysis of people and business models. So the core of our current investment philosophy is really the analysis of the qualitative aspects of businesses from a competitive standpoint, and the capital allocation ability and execution ability of management teams. So it's really those two pillars that hold up our investment process. And it's a long answer to your original question, but it really comes from this idea that's very much a Buffett Munger idea, which is there will ultimately be a convergence between stock prices and the underlying compounding of the businesses at the fundamental level on a per share basis. So if you're a long-term investor, what that means is that if you want above average stock price performance, you really need to be looking for above average internal business compounding. And if you take microeconomics 101, you'll learn that if if I'm earning in excess of my cost of capital as a business over time, you're probably going to open up a shop across the street and compete away my economic margin. And we'll end up earning our cost of capital over the long term. That is, unless one of us has a unique competitive position in the marketplace. And so it's our job as analysts, our 8-person team in Austin, is to run around the country and to find those unique competitive characteristics of small and microcap businesses. Moreover, we want people that understand the moats around these businesses, how to expand them, and how to protect our interest as outside passive minority shareholders. And if we find that recipe, that should drive the quantitative results that we're looking for. And I would also add that the wisdom of doing that, from my perspective, is that we insulate ourselves, that is Bears Capital, from competition. Because it's hard for other managers to replicate the work that we're doing in the space. Anybody can get a database of companies and filter it on price to earnings, price to cash flow, return on equity, and come up with quantitative metrics that lead to potentially good stock price performance. But what they don't realize when they're doing this is that other managers could happen upon that same recipe, and through competitive arbitrage in the marketplace, by committing significant capital to these strategies, nullify their value over time. And you wouldn't even know that your strategy isn't working until it's too late. And by doing it the way that we're doing it, hopefully we're happening upon these qualitative stories earlier than other managers, before the financial results have been outed in 10Ks and 10Qs, and before the screeners have really picked up on the seductive aspects of the business, so to speak. So that's why we have a sort of qualitative first approach. It's very much grown out of me seeing in my early investing career what frankly hasn't worked. And it's worked for us for the last 12 years. Our strategies have done very well versus their benchmark indices, and I really credit that qualitative first approach as a reason for our sustained outperformance. And again, I look at our business from a moat basis, and what sort of Porter's 5 forces can we bring to bear on our own business to ensure that another manager with similar capital can't replicate the sort of work that we're doing. And I think the answer is really just admitting that we have to do the hard work. We have to get on airplanes and in rental cars and go out and visit as many of these small cap companies as we possibly can, and catalog a database of qualitative characteristics of companies.
You mentioned that it's difficult for others to replicate your approach, and that you have an edge versus others. Can you help us understand a bit more specifically where that edge is? Is it in getting to the right information first, or getting to information that may not be available to others, or is it in applying judgment to the information that we have?
No, it's a great question. I think a lot of people mistake small and microcap managers as having an informational edge in the classic sense. That is, they're finding information that will reveal more accurately what next quarter's EPS numbers are, or maybe finding an undervalued piece of real estate on the balance sheet or something like that, where that value somehow outs itself in the marketplace. We have found that to be sort of a mistaken perception about small and microcap managers, and it's certainly not applicable to us. We feel like our edge is in analysis, but it's in the qualitative analysis of those factors that are germane to internal business compounding. So we make no bones about the fact that we probably, we think we have a good handle on the financial characteristics of the companies that we analyze, but we're not in the game of trying to outguess, analysts, if they're actually present in our names, about EPS numbers or things like that. That's a very short-term way of thinking, and is analogous to the sort of beauty contest that Buffett talks about. And we're definitely long-term investors, and are in the business of attempting to identify the winners before the financial fruits of that winning bears itself out. And we have, for example, one name in our microcap portfolio that's been in there since inception for 12 years. And so long as the internal compounding of the business looks great, we're happy with the management team, then, unless it gets wildly overvalued, it'll likely remain in our portfolio. So, the edge we have, I think, is related to time horizon. It's related to the fact that we have very patient capital. The structure of our business is pretty unique in that we have found a receptive audience among foundations and endowments primarily, and they're long-term, non-taxable entities that have largely invested with us on a direct basis, so there's no capricious calls on capital that would disrupt the names within our portfolio. And so given their patience with us, we have sort of exploited that as yet another advantage. We can say we can have a 5, 6, 7 year time horizon investing in names and waiting for those qualitative characteristics to really out themselves in the numbers.
For value investors, management is a key part of the investment case, and I'm curious, it seems sensible that in the small cap space with smaller companies, management is even more important. How do you go about assessing management?
Well, there's two parts to that, and the first, I think, is understanding what average looks like. And you have to meet a lot of management teams, hundreds and hundreds of management teams, to really get a baseline for what exceptional looks like. And it's difficult to judge the quality of management from a single meeting. If we fly out to Sioux Falls, South Dakota to meet with a company, and we meet with management, and it's our very first field meeting with a management team, we have no baseline to judge whether these managers are exceptional or not. We may be very enamored with them, but 30 meetings later, we may look back on that first meeting and say, well, this management team isn't so exceptional, or maybe they were, but we have developed a baseline over time. And so I think I think that first and foremost, it takes a lot of experience in the space to be able to discern whether management's exceptional, both from a capital allocation perspective and from an operational perspective. The capital allocation piece, you can be reasonably confident based upon being a large outside shareholder. Hopefully they'll protect your interest as they would your own. Perhaps alignment of incentives on the proxy statement that you can discern from SEC filings and so forth. The other piece to the question is that if management teams are delivering kind of an encore performance, that's something that we're very attracted to. If a particular manager or a team of managers has had success at, say, a larger cap company, maybe a large multinational that's like a GE or a Honeywell or a Danaher Corp, an encore performance for this team in a small cap company may be a good quote unquote jockey story to bet on, because operational excellence in a prior life usually manifests itself as good or better in the next life. Usually they know what mistakes they're potentially going to make, and they'll avoid them this time around. They're usually quicker to build the value they're attempting to build the second time around. So that kind of encore performance is something that has become a common theme in our portfolio.
And you mentioned the importance of qualitative analysis, and do you screen at all? Can you help us understand how you generate investment ideas? Do you have a database of companies?
Yeah, so we do exactly one screen, and that is a market cap based screen for the entrance or the available universe that we have. And other than that, we do no screening. And that's pretty unusual for small microcap managers. And it admittedly leaves us open to not being able to cover every single name in the space, despite the fact that we have a 12-year history and 8 people that have met with literally hundreds of companies. We still haven't seen them all. Ultimately that's the dream, but we don't want to have that screening process artificially influence our search. And that for all the reasons that I articulated in the first part of this interview. And so what we really do is allow our analysts the intellectual freedom to pursue their curiosities about businesses. And so long as the names that they're looking at are congruent with our stated investment philosophy, then it's okay for them to go chase down interesting names. And idea generation kind of comes from all over the place. As I mentioned, encore performances by management are something that we sort of track from company to company. Oftentimes, geographic proximity is just a reason for a name becoming interesting to us. We may go to Chicago to meet with a company, and as long as we're in Chicago, we may stay there for a week and meet with 3 companies a day for 5 days, and we may come back with a different idea than the name that we went there to research. So it just sort of comes from all over the place. We want to remain fluid. We do a lot of reading in the office. but we don't want to artificially pollute our process with some mechanistic or quantitative metrics that are factor modeling or filtering that lead us down a path that isn't consistent with our stated investment approach.
In your investment career so far, you've met with hundreds of companies, or if not thousands, and were exposed to different businesses. I'm curious, do you have any mental models when it comes to classifying the business models of companies, and what do you look for? Are there any business models that you think are underappreciated by investors?
It's a great question. So we have naturally gravitated towards industries where returns on capital are just chronically high, and avoided those that the reverse is true, where high capital needs and maybe fixed capacity or issues over time. Airlines, steel companies, things like that tend not to be big areas of focus for us. Business services, precision instruments, things like that, they tend to produce a lot of names that are very interesting to us because the industries themselves are usually reliant on intellectual property, or they have some network effects implicit in the business models, competitive lock-in, things like that allow for high returns on capital over time. So we tend to gravitate toward specific industries. And in terms of mental models, I would just say that anything that's consistent with the sort of Porter's Five Forces. Hal Varian, an employee at Google, talks a lot about these neoteric forces that are sort of newer versions, I think, of what Porter had talked about. That we attempt to follow those models wherever they lead us.
A lot of investors, when they hear small caps, they may be convinced of their historical outperformance, but then often what gets mentioned is illiquidity or some of other, disadvantages that people associate with small cap investing. How do you view that dilemma, and what are perhaps some of the disadvantages that you've come across that may be more important than illiquidity?
Well, you hit the nail right on the head. Where the biggest problem in our space is illiquidity. But it's actually something that we are gravitated toward because we know that if we can clear that hurdle, it's a competitive bar that our peer managers are not going to try and clear. And the natural thing that happens in our space is for a manager to produce good numbers and then to graduate out of the small cap space and into mid and large cap, where their advantage starts to disappear. Or they may over-diversify their portfolio and become the index and yet try and charge active fees. And so the people that chase good performance tend to have poor results. We have made sort of a long-term trade that says that we're going to cap our asset base to maintain flexibility and optimal asset sizes within the space to produce long-term investment results that we can be very proud of. Now the trade-off becomes we are giving up permanently potential compensation. Growing our asset base would be very beneficial to the owners of Bears Capital, but we have said we're not going to do that. We're going to stay sized appropriately so that when our careers are over, we can look back on a long-term track record that we can be extremely proud of. And so that means giving money back after a period of good performance. It means hard closing your strategies to new investment, which we've done. And so that's, you have to make certain trade-offs, I think, to maintain your advantages in the space. But illiquidity is definitely an issue. It takes us, especially in our microcap strategy, sometimes weeks or months to get into and out of positions. And we think we're pretty good at trading and finding the other side of the trade, but those trades can be costly, and cost is not measured in terms of cents per share on explicit commission rates. Costs are measured by both market impact costs, what impact are you having on the market by allocating a huge amount of capital to a very illiquid name, and also implementation shortfall, meaning that the names that you miss because you're trying to get a material position in the portfolio and you're not able to do so, the position runs to a price that you're not willing to pay, and you've permanently left money on the table, and that's not really captured in the traditional ways of measuring trading costs.
Let me just say that limiting asset growth, that is so rare and so commendable. not many managers will do that, and certainly is very rare in the industry. I'm just curious, you mentioned that you limit the assets. Is there a figure, or how do you go about it?
Yeah, we limited our microcap strategy at $130 million in contributed capital. We have a small cap strategy that's currently open that we will limit at $500 million in total capital. And we don't have a performance carry, so I think a lot of managers live, but they'll say, well, we'll limit capital, but our performance carry will sort of create vast amounts of personal wealth for us as managers, and we don't have that. And it's largely because of our structure and the fact that we have nonprofit clients and things like that. But we live, eat, and take profitability from just the base fee that we have while limiting assets. So while you say it may be commendable to some on the outside, it's fun to do what we do, to be a treasure hunter in small cap stocks. No one around our office is complaining about the job that they've been blessed to have. So,
and this perhaps brings us to the wider topic of small cap versus larger cap investing. And I know you're very passionate about the case for small caps. You've written a wonderful book called The Small Cap Advantage. Could you perhaps tell us a bit about what motivated you to write that book in the first place?
Sure. Well, I think a lot of the things that we just talked about limiting assets and about the structural advantages that are available to investors in small caps are underappreciated. I think most people think in the back of their mind that small caps outperform large caps. I've heard that somewhere, but I wanted to present the data to support that, number one. Number two, allow people to realize that the outperformance has actually been more persistent over time as well. In rolling 20-year periods, small cap stocks actually outperform large cap stocks 80% of the time since they've been keeping good data in 1926. So that persistence of outperformance is something that most people don't realize. But the big things are, if you are an active manager, that is, if you're a stock picker, there are a whole host of reasons, structural reasons why professional competition is limited in the space. And it allows you as an individual investor or a professional investor, if you structure yourself correctly, you can exploit classic market inefficiency. And it's just sort of reinforcing the case there. And honestly, the book is really intended for two audiences. The first is for the sort of semi-professional investor who wants to get into the space, who wants to be a small cap manager. And talking about the ways to structure your strategy, your firm, to take advantage permanently, frankly, of the inefficiencies in the space. But the second audience is really for the due diligence professional. There are a lot of large pools of capital in the U.S. and outside the U.S., frankly, that do due diligence on investment managers that have unreasonable restrictions for track record, assets under management, and things like that, that are precluding them from investing in the small cap space with talented, young, dynamic managers who maybe don't fill those check boxes perfectly. And I think that the world would be a much better place if those types of managers would have access to institutional funding. One of the main things that's different about our firm from our peers is that we have largely institutional funding. And our clients, we're a bit unique in that our clients took a chance on us when we were very young and nobodies. And that story is not very common, I'm finding, among my peers. And the other managers that are, in the hedge fund space or long-only space that are pining for capital tend to find receptive audiences in the high net worth space where, wealthy people can just frankly write a check and there's not a huge due diligence process to go through. They're enamored with a personality and they trust them and they say, here's, $100,000. But that should be happening more with institutional dollars, and it's not. And so the book really is meant to get into the hands of some institutional due diligence professionals, the public equities teams at large pools of capital where they're doing direct due diligence on managers. And it's meant to influence slightly to say, look, you have to give up some of those traditional restrictions you have for large cap and mid cap because the great small cap managers close very early after a period of good performance. And you need to throw away this restriction that says I need 5 years and $1 billion in capital to invest with a manager because by then it's too late.
And what advice would you give to some of the people who are just starting out in the business, have started their fund, and they are encountering some of the problems that you've just described. Based on your experience and success, what advice would you give to them?
Well, I would say that the mistaken notion I see among my peers who are just starting out is that they feel like they need a period of good performance before they can start marketing themselves and their firms. And the fact of the matter is that the best institutional investors are attracted to a robust process and investment philosophy. Really, they're looking for a repeatable investment edge. So if you can articulate clearly a repeatable investment edge over time, and you can convince an institution of your ability to execute on that edge from an organizational perspective, then I would say that you have a good shot at getting in front of the right people and competing for institutional dollars. It doesn't matter whether you had 3 months of great performance or a year of great performance or 3 months of underperformance or a year of underperformance. It's just get out and market yourself and clearly articulate your investment edge. Also, this notion of being a great compounder and hiding in obscurity, and letting investors just come find you, it might work after 10 or 20 years, but there are a lot of great investors out there, and the competition for especially institutional capital is very high. And so I think that the lesson there is that you need to do some marketing. And that's a problem because marketing time is time spent away from the core investment process. And nobody wants that either, right? And so it's this difficult trade-off that you have as a manager, especially early in your career where you're probably a one-man operation and doing everything yourself. You have to spend a little bit of time raising your profile in the eyes of the people who are most likely able to give you institutional dollars.
You mentioned repeatable investment process. I'm just curious, can you expound on that a little bit? You talked about what makes your approach so successful and where you have an edge. Just, I guess, with other approaches perhaps, what is that repeatable?
Well, I think it can take all sorts of different forms. I know peer managers who have institutional funding who, for example, focus on frontier markets. Maybe a certain geography like Africa where there's, a lot of market inefficiency, and perhaps the investment team has some real sort of boots on the ground experience in a geography like that. Or perhaps there's a specific sector that a manager has particular specialization in, like maybe technology or biotech, things like that, where there truly can be an analytical advantage garnered by the right investment team. So I think any place that you can exhibit an edge over your competitors, then I think you have a decent shot at garnering institutional allocations. But it's about packaging that in a way that's appealing to your target market.
What are some of the key pitfalls, in investing in general, and specifically in your space?
Well, especially in the microcap space, some would call certain names roach motels. You can get into the stock, but you can't get out. Especially if you've incorrectly identified the competitive mode around the business and the management team. We are not without our mistakes in our investment track record and have been subjected to some of those situations in the past. But there's a reason we have 10 stocks instead of 2. We're not always going to be right. So yeah, there definitely is a pitfall of operating in the small microcap space where liquidity can work against you. I would say more often we've had the experience where we've had a very difficult time getting into the position, but the investment case has worked out and liquidity picks up. Maybe the company's added to the Russell 3000 or something, and maybe 5,000 shares a day, and average daily trading volume turns into 75,000. And so the exit is much easier than the entry. So that's certainly one pitfall. Other pitfalls are that management teams are often not as experienced. They may not even be as experienced in investor relations and understanding Reg FD, and so we have to be very careful and very conservative about the questions that we ask and how close we get to certain situations in companies. So there are certain unique factors in the small cap space that make it more fun, but also more problematic. I mean, in the large cap space, you tend to have a unified investor relations effort by large companies where everybody's treated equally under Reg FD. We have been to certain companies that have said, we haven't had an investor here in a year or 2 years or 3 years. And so the company's so small, there's no investor relations effort. It's typically just the CFO and the CEO. They may give you a company tour and things like that. And so you literally see the market inefficiency there for the taking. But you have to be careful about what you can and can't ask, what you can and can't say, and the information that you're provided with.
With your focus on good businesses, I'm curious if you could share with us some of your valuation approaches. How important is price and this definition of fair price, paying a fair price for a good business? Walk us a little bit through your valuation discipline and what approaches do you like to use?
Sure. And to give you a sort of a prelude to that, our qualitative search for businesses is really a search we think of as a search for the 40 best businesses in the space. And that's internally what we call our focus list of companies. So these are companies that meet our qualitative criteria for competitiveness and for management. And once we've identified those and have done a lot of research on the qualitative aspects of the business, we've approved them as businesses that we would want to own. Then we do valuation work. So valuation actually happens at the back end of our process. And our 10-stock portfolio is really a reflection of the 10 highest total return ideas from our focus list of the 40 best businesses that we can find. And the valuation is really a DCF. It's derived from the McKinsey book on valuation. It's evolved over the last 12 years as we've sort of modified it to suit our internal needs. But it's pretty traditional in terms of it being a free cash flow DCF model. We use a 10% discount rate across the board, which there are a whole host of theoretical reasons why we do it that way. And the output of that appraisal, over time, we have become, frankly, less reliant on. We don't calculate these intrinsic values down to the penny. Somebody once said that a DCF is kind of like looking through the Hubble telescope. If you tweak it a little bit, you're in a different universe. Meaning that the DCFs are very sensitive to the inputs, and so we have to stress test our ideas by using different inputs within the DCF. But mostly, it's an exercise in understanding what the key performance indicators are for each company and how dollars flow through the income statement and impact free cash flow generation. So I would say that there's nothing overly special about our DCFs versus other managers. But we definitely are disciplined in terms of our purchase prices. We want to buy 50, 60-cent dollars. But where we're not as disciplined and where we're much different than other managers is in our sell discipline. A lot of managers will rank order their portfolio based on price to intrinsic value and kick out the names that are 100 cents on the dollar and buy the names that are 50, 60 cents on the dollar. That is admitting that each idea is fungible, that each idea is qualitatively equivalent. And we don't believe that. So our 95-cent dollars in the portfolio may be our highest conviction names from a qualitative perspective. And rolling out of a 95-cent dollar and into a 65-cent dollar that is a lower quality business isn't all that rational a process for us, especially when we understand how quickly those appraisal numbers change and how dynamic those numbers are, especially for companies that are relatively high growth companies. So that's a very long way of saying that we use price to intrinsic value as a firm guide when buying, but we use it as one of many factors when selling.
The 40 companies that you have identified as potential investments, curious, when do they get replaced? Small companies are dynamic and perhaps the business model has also changed. Is it often that you replace these companies because you find an even better company, or you actually realize that in a year's time the business model may have actually changed a bit?
That's exactly right on both counts. We have a dynamic focus list, and as business models change, we're monitoring all of the focus list companies. As business models change for the worse, those companies are removed. Over time, hopefully the bar for entry onto the list keeps getting higher and higher and higher as we see more and more businesses, as we get better at our jobs. And yes, and the number 40 is not a number set in stone. The focus list sort of expands and contracts just sort of based upon what's happening to the underlying companies and what our opportunity set is sort of telling us. But that's the framework under which idea generation happens.
Some small cap managers tend to also focus on the potential for an acquisition by a larger company, especially if it's a good business. Or I'm curious whether that's been a source of your returns, where the companies you've invested in, you recognize something early on, and then these companies get acquired.
We don't have that as a central tenet of our investment philosophy, but it is often the byproduct of just identifying a great company. So maybe a half a dozen times or so in our history have we had small companies get acquired by larger ones. And most of the time it's a great situation for us. It's an immediate realization of a premium valuation. Oftentimes it is a huge disappointment. We've identified perhaps a small company that we feel like could be $1 billion, $5 billion, $10 billion company, and they get taken out at a modest premium to market value at a very early point in their life cycle. And so we want to see all 9 innings played, and if they get taken out in inning 2, we sort of feel like, well, that's a great short-term performance number for us, but it's really leaving a lot on the table. So it's most often good news, but oftentimes is a bit of a disappointment to us.
You've been very much focused on the U.S. Have you been tempted by opportunities internationally?
We have a mandate from our institutional investors that keeps us in the U.S. We, I think, have owned one Canadian stock in the past, but generally speaking, those have been dual listed, and so we stay in the U.S., we understand the U.S. I can't imagine a time in our future where we would go outside of the U.S., but that is not to say that there aren't great opportunities outside the U.S. for people. In fact, I would argue that in some cases there are better opportunities outside the U.S., but that's been our mandate, and that's the rules of the game that we've been given, and so we play by them.
What would you say is the single biggest mistake that investors make?
I would say that, especially to the value crowd that that sort of follows sort of Buffett monger philosophy, it's this mistaken notion that a low PE stock can potentially outperform. Companies with low valuations on rule of thumb metrics like price to earnings, price to cash flow, price to book are often indicative, even in the small microcap space, of broken businesses. They're value traps. They are poor competitive businesses run by management teams that are treating the company as a personal cash machine. They may essentially be a declining annuity that deserves to be valued at, say, 6 times earnings, 3-4 times cash flow. And so, this idea that, low PE stocks outperform over time, I know has been, I talk about this a little bit in the book, has been reinforced by research by Fama French and others. I sort of view low multiples as an indicator in terms of telling me that it's probably, a chronically under-earning business on its capital base, indicative of poor competitive position. That's the thesis that I start out with when I see that sort of valuation. And it's not always the case, but it more often than not is reinforced. So I think, that's where the screeners really get led into poor performance, is in the identification of these companies that frankly deserve to be cheap.
Have you changed anything as a result of the financial crisis over the last 3-4 years? Is there anything that you pay more attention to? Or?
Certainly, we're very more aware of balance sheet risk. The good news about our strategy is that we tend not to gravitate into financials because there is poor competitive differentiation among regional banks and thrifts, which is a large part of the small and microcap universe. So we, not being involved in those names in the first place, we never got caught with our pants down, so to speak. But we're definitely more aware of companies that we assume can just refinance debt. There are environments like 2008 where that assumption can really bring down a fantastic franchise, and so I think we're a bit more cautious about it. But generally speaking, we are looking for the same things that we were previous to the financial crisis. it really hadn't changed much. I would say that it reinforced the wisdom of buying competitively strong companies, because in times of economic malaise like 2008, 2009, weaker competitors get washed out, and the best competitive companies tend to consolidate earnings power in those times. And so when times normalize, they come out stronger. And we saw that in a few names in the portfolio.
And how comfortable are you with technology when it comes to your circle of competence? Can you give us a sense of, you mentioned financials that you don't particularly like. What others do you avoid?
Well, I would say that financials aren't necessarily outside of our circle of competence, but I think the competitive differentiation is such that we don't really see high returns on capital in a lot of those names. There are certainly names in the financial space and others that are outside of our circle of competence, and I think we try to, like a lot of other investors, tend to play well within it. There's the good news in the small cap space is there's so many names that the too hard pile is an easy one to just throw companies into, and we do that quite often, especially in biotech and things like that. We don't have any PhDs in chemistry on staff that can, tell us whether a certain drug has better promise than another one, and so those companies get sort of kicked out of the process pretty early. There's some technology companies, precision instrument companies that we've met with where I've walked out of a 3-hour meeting with a company saying, I have no idea what that company does, and that's not because they're trying to snow me over. It's just because I'm too dumb to understand the high technology that they're employing, and that's okay. There are plenty of other opportunities to go pursue. There are a lot of names where I feel like I could get up to speed, but it would just take a really long time, and so you have to ask yourself where your value added is. And so we have certain people on our staff with different competencies that somebody may have an engineering background and be better suited to analyzing a particular company. Others may have financial services experience, and so that they're better suited for that, for those types of ideas. And so we try to play to our team's strengths from that standpoint too.
And to follow up on that, in terms of time management is such a critical factor. A lot of managers who focus on good businesses, I guess, face that dilemma sometimes. How much work is enough? You could study a business and the Porter's 5 forces, and really, do you have a discipline regarding time spent? And
that's a fantastic question, and that's another area where I feel like some managers have taken it to the extreme and handicapped themselves. You can go stock the shelves at a retailer and know everything there is to know about the company, but it may be the wrong company. And so understanding where, first of all, the competitive bar for excellence is from a research perspective is incredibly important, because you can't fool yourself into thinking you've done good work if that work has been replicated by hundreds of others, on the buy side and the sell side. So you have to know where the competitive bar for excellence is in understanding a particular company and analyzing a particular company. But you don't want to go so far that, you can't see the forest for the tree, so to speak, and B, you handicap yourself by getting too close to a company and restricting yourself as an insider or knowing things you shouldn't know and handicapping your ability to trade flexibly the name. And so we have, it's taken a while, but we have sort of feel like we've honed in on where that bar is better than most. I certainly, was more naive about it in the early years of my career than I am today. I think the pendulum has gone back and forth over time, where we've probably gotten too close to companies in the past, and then it's swung the other way, and then it swung the other way again. And when you get invited to dinner, to the CFO's house, you have to just sort of turn away those types of invitations sometimes, because you don't want to get too close for obvious reasons. But also, some of the information that you're garnering just becomes noise. You have to ask yourself, what's important and material to a particular investment thesis? And, if you start stocking the shelves at a retailer, you might start getting a skewed or jaded view of the company as a true insider, because, you don't like the way the manager treats the employees and things that are, may or may not be germane to the key investment thesis. It's really about what's the competitive advantage of the business? What are the key drivers of this business? Why is it going to win over time? And who are the people that are going to help it win? And if you get those factors right, you don't necessarily need to know all the minutia that that I think people mistakenly infer that they need to go be chasing down. Those little data points that, what are same-store sales in Kentucky? It just, some of that stuff is just immaterial to an overall investment thesis. But it takes a while to hone in on exactly what those factors are.
Also in the small cap space, there are plenty of, for lack of a better word, activist investors. How do you think about that component? Do you think it's necessary, and how engaged do you want to be with companies?
We have never filed a 13D filing, meaning having the intent or to influence management or the company strategy in any way. We've been passive shareholders the entire existence of Bears Capital. I would never anticipate that changing, although I'd never say never. But we feel like there's so many opportunities in the space that we can find great companies who are already doing things that we like. And we don't need to get our hands dirty with messing around with businesses that need to be changed. I have found that management teams are not, especially those sort of owner-operator, founder-driven companies that we're attracted to, because typically there's a large outside shareholder or insider share ownership. Those types of companies, don't react very well to some young financial professional with outside capital telling them what to do with the business that they spent their own blood, sweat, and tears creating, and they'll clam up immediately if they suspect that you are in any way trying to influence the company. So for us, it's more about wielding soft power. It's prove that we have a structural advantage with the sort of investor base that we have, that we're going to be long-term, seeing a history of 12 years of us being long-term, and admitting right up front that we love what they're doing. At that point, we are asked about things that, capital allocation and things like that. Hey, what would you think about a share buyback? What would you think? And at that point, we don't need to influence or anything else. We can listen and maybe be a good sounding board for different options at that point. And so by inculcating that trust, I think it's paid far larger dividends than us finding some underperforming company and trying to shake things up by taking board seats or replacing management. That never seemed to me to be a recipe for long-term fantastic performance. I know others have practiced it successfully, but it's a business that, frankly, I don't think we'd be very good at.
That seems a bit ironic, perhaps, because your capital base seems very long-term oriented and perhaps even locked in, which has been actually one of the key challenges for a lot of activist investors, especially in the crisis of '09, that their capital just left.
Yeah.
Presumably, you wouldn't face that issue, which may.
Well, we don't have capital locked up. They just like us and have been patient with us. So so I'm not sure we'd have the exact advantages that you may be inferring, but I would say that the overarching issue is, does activism deliver superior returns over time? And I've never seen the evidence for that. Perhaps it's out there. The data is really hard to come by, given the survivorship bias inherent in the data compilation. And I would say that just based upon what my experience has been in investing, A, we wouldn't be very good at it, and B, if we tried to be really good at it, I can see a whole host of reasons why there would be a lot of people trying to prevent us from being good at it. And that's usually not a long-term recipe for success in my book.
You've written a wonderful book on the small cap investing space. What other books or resources would you recommend to investors who may be approaching the small cap space but are not quite sure where to get some really good advice?
Well, conceptually, from an investment process and philosophy standpoint, obviously the Berkshire Hathaway annual reports going back, and even his partnership letters, are a great source for understanding the concept of viewing a stock as a business fundamentally, and understanding that to be successful in the stock market, you need to be successful in owning businesses that compound at high rates over time. I think that's a fundamental tenet that I took away from sort of the Buffett Munger philosophy. I think the more Munger influence of buying high quality businesses over time that compound because of that convergence between stock price and intrinsic value, is probably even more of a fundamental tenet of our process. So anything by the two of them, I think, is great. All of the books that have been written about them, I devoured in my early investing career. I like business biographies. Business biographies tend to just show how passionate people who live and breathe their business have created something out of nothing. The Sam Walton biography. I recently read a biography of In-N-Out Burger on the West Coast, which I thought was really great. So anything that you can get your hands on, modern business biographies have been extremely beneficial, I think, in understanding the characteristics of management teams that are exceptional, especially because they all don't look identical, but there are some common, personality characteristics. I think the McKinsey book Evaluation was very helpful in constructing our original DCF models. But I think more than reading the entire finance section at Barnes and Noble, probably a better approach would be to start reading as many annual reports as you can get your hands on, because that's what's really happening in American small business, publicly traded small business. And so you start to get a feel for what exceptional looks like by doing that. Everybody in our office, oddly enough, even though it's kind of an individual investor tool, reads Value Line cover to cover every week, the paper edition. And it's just sort of mental weightlifting for us to get a sense for what returns on capital, returns on sales, sort of common size financial statements look like for particular industries over time. And you can sort of see that, hey, the precision instrument space has really delivered fantastic results for investors over time. And hey, look, the airline space has really done the exact opposite. And you can start figuring out, what industries and sectors are doing really well, which ones aren't. And that can help hone, your investment process a little bit and focus your time and energy on the right places.
You mentioned the limits on assets that you seek and the focus on performance. Could you speak a bit more about the goals that you have for your firm?
Yeah, so I think we're done. Once we've raised the $500 million in small cap money, we don't have any ambition beyond that. We're not, quietly seeding the Bears Capital large cap strategy or anything like that. We're done. At that point, we have the capital base that I think we want, that can deliver on what we promised our investors, and at the same time can provide the resources to have a well compensated and motivated team of professionals. I don't want to be managing 5 or 10 different strategies and hundreds of people. That's not my goal. My goal is to stay as close to the investment process as possible. I love stock picking. That's why I got into the business. I don't want to design myself out of it through just the ambitions of growth for the sake of growth in terms of the organization. So that's really it. It's pretty simple.
Great. Well, on that note, Brian, thank you so much for your time and all the insights.
Thank you.